This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I am your host. Super excited. We have another great guest today. Welcome to the show, Matt Caruso.
Hey, thanks so much for having me, Jonah. It's a real pleasure.
Thank you. And you're in Canada, right?
That's right. Yeah, just north of the border.
So a few things I just want to get out of the way with Matt. So Matt was the top finisher, not first, but I'm guessing top 3 or 4 in 2020 in the investing championships with a 346% return. It's just insane that didn't get him first place that year, but it just goes to show it was a pretty crazy year in the markets for growth stocks. I think he owned some of the stocks that some of us probably owned as well. He just traded them a lot better than we did and, knew when to hit the gas pedal and how hard to hit it. So we'll get into that. We'll talk about what he thinks right now about macro, the markets, what his personal investment strategy is, and this sort of a kind of sideways, choppy, unpredictable market. So let's jump right in. Let's start with 2020. I mean, that was obviously a good year for you. What made it such a great year? I mean, we know, market crashed in March 2020. We know a lot of those cloud stocks, cybersecurity, e-commerce, all did well coming out of the bottom of the pandemic, or at least those March lows. How did you get positioned, let's say March, April, May? How are you positioned in, coming out of that to put up such incredible numbers?
So for me, there's really like 3 main tools that really helped me to kind of pivot and be in the right place at the right time, especially in 2020. I'll use like a market gauge. I look at number of new highs versus new lows. So that really turned really negative really early at the beginning of the COVID drop. So I missed that whole drop, which was very important. And then that turned positive very soon after the bottom. And I was really exceptionally bullish because a lot of my background is I used to really focus on precious metal stocks earlier in my career. So I've always had a good understanding of the Federal Reserve and its power. And nowadays, I think people are starting to put a little more emphasis on the Fed, given what a big impact they have in the market. And so when I saw what they were doing as a result of COVID, I remember like that night, I turned to my wife when they announced rates going to 0 and reserve requirements to 0 and QE starting. I said, well, the bear market's over. She's like, what are you talking about? Everything's closed. I'm like, I've never seen so much firepower directed at the market at one time. So It's kind of, that was like my global view. And I really believe the Fed is what sets the big trends, like bull market or bear market, the Fed decides. To make sure I'm on side, I'll use kind of the market tools to make sure the market's agreeing with what the Fed's doing. So then, we got net highs. And then I really look at relative strength. So which stocks are winning? So, I mean, if you kind of logically break it down, it's like, look, do we have this big push from the Fed? Yes. Is the market also showing that that's true? Yes. And now which stocks are benefiting the most and likely to continue if they benefited so far? And that's a relative strength. So that kind of just like zeroed me into the right stocks and with a very aggressive stance because of what the Fed was doing.
And what were some of those stocks that you zeroed in on early in March or April?
So it's kind of interesting. And I remember at the time, and now in retrospect, it's almost like, in real time, things can be so tricky, and sometimes you get it so wrong, but this time I got it so right. And I remember thinking, this is like a war, a health war. So I kind of like really like look back at like World War I, like all the steel stocks and what they did, Bethlehem Steel and all this stuff. I've kind of all these charts that I've kept. And I said, the real winners are going to be anyone that's going to really directly benefit from the health spend. So my first really big target was Livongo. So it's actually not even traded anymore. It was bought out by Teladoc. Yep. But Livongo was a major focus of mine. And actually my returns that year would have been so much better, but my broker at the time wouldn't extend any margin on Livongo. It was a recent IPO. And so it was like I was trading it like on a cash basis. So that was a big part of my portfolio, and all that money was kind of sucked up and I couldn't put in other names, but I was so bullish on Livongo because it was like remote diagnostics. I mean, it was everything you would have needed in that situation. And then, so health was my first focus. And once I realized kind of this staying away from everyone was going to be a thing, then everything tech related and things like FSLY and, the Trade Desk, which was online advertising, and all of these stocks became front and center. So really just identifying the key themes that were going to benefit.
It was wild. I mean, you look back now and I wish I had been even more aggressive than I was. I wish I had really leveraged up on Shopify and cybersecurity, and like you said, Snapchat, Meta. I mean, where people were spending all their time, and where everyone's money was going. I mean, money wasn't going into the hospitality sector anymore; it was going into gaming and Amazon and whatnot. As the year progressed, and we got some of those attempted rotations from growth into value, every time we thought we might have a vaccine, and then that would last for 2 or 3 weeks, and then we'd rotate back into growth. Did you what do you do in those instances? Do you get out of your stocks? Do you hold them, just keep your stop losses tight? And that was just, those were violent rotations that you don't see very often.
Yeah, I agree. And so it really depends how you're positioned with your stocks. I mean, if you're trying to initiate positions, and this is why sometimes, there's the benefits of short-term trading and the benefits of having a bit of a longer-term view. And I my approach brings both in. Because I was a market maker early in my career, the day trading skills I learned will always stay with me, how to read a market and all of that. So, I have a good pulse on the short term, but I try and focus on the longer term when I can. And so a lot of that, the answer to that question really depends how you're positioned. So if you're in a stock that you got this really big cushion on and you have this big view, so it pulls back 1 week, not a big deal. But if you're trying to initiate and the stock rolls over on you quickly, you don't really know at that point in time, hey, is this trend over? Like you're saying, is there going to be this push to value now? So you need to cut. So the year ended a little bit choppier for me because a lot of the great trades I had put on, like Livongo was bought out. I was able to sell that near peak prices. FSLY, which was a big position of mine, had a loss of their top customer, TikTok, which caused a big gap down. So I was kind of kicked out of some of my big winning trades, either for good or for bad. So then while trying to position, it got a little bit trickier, a little choppier end of the year. So some trades I got well, some didn't, but I wasn't able to get the same kind of size as I had earlier in the year because the market was choppy. A big part of it too is not just if you're right or wrong, but how much size can you get behind that trade when you're right? I think that's an important factor people sometimes kind of don't focus on.
So in a bull market, when the trends are working in your favor, we're making new highs, breath looks good, all of that, Fed's behind you. How many positions will you typically try to hold in your portfolio?
So again, I'm very concentrated. I'll trade I wouldn't trade other people's account the way I trade my account. It's almost funny. You almost kind of, you're almost more risk averse with other people's money than your own. It's a weird thing. But so my account, I usually like to get to about 5 or 6 stocks that I'm very confident on that I can concentrate into. I never get too wildly on margin, even if I'm really confident. I never get to 200-300% invested. I wouldn't be able to sleep at night. But for me, usually if I'm 120 to 150% invested at my max, that's usually where I feel comfortable when I'm a risk on. And I like to be in probably 5 positions is an ideal. So if I have to kind of really bring it down, that's where I'd like to get to.
Okay. And then, so 2020 was a growth year, cloud, cyber, e-commerce, all the stuff we just talked about. Mm-hmm. And then you saw the rotation. I don't know if it was late 2020, early 2021, you started getting into the value stocks were outperforming, energy, some healthcare, consumer staples and utilities and all those boring sectors. When did you rotate in, or did you rotate in? And, because I know some traders, those value stocks don't necessarily give them enough beta. They like the growth stocks, and if growth's not in favor, they'd rather almost be in cash than sit there and trade utilities and Procter and Gamble and J&J and those types of companies. So what did you do as we transitioned from the growth trade to the value trade?
Yeah, 21 was slower. I think that looking back, the part that most frustrated me was 2020 was so great. I planned this great trip to Hawaii for January, which didn't work out because of the whole pandemic situation. So the best bulk of the gains were probably January, February. So I was and then everything blew up. So then I was kind of on the sidelines for a little bit because I was almost surprised that, the rotations were so strong because that was able to lift the indexes. But from February into summer, there were big drops. Anyone who was kind of, who wasn't careful from that February peak got really hurt just going into summer. So that period, I didn't do a whole lot. Year end was really trying to refocus on what was coming next. And that's where I was trying to pick up on a lot of the trends, especially on the energy trade. Part of the economic cycle is later in the economic cycle as inflationary pressures build, energy cyclicals are going to benefit. And that's kind of where I really started to put my focus in stocks like DVN, especially at the tail end of the year, into fertilizers like Mosaic, which then once Russia invaded Ukraine in 22, that kind of put a real, push into that space specifically. So that was kind of the rotations I did into 21 going into 22. That's how I kind of pivoted.
I forgot about the ag trade. Yeah,
Yeah.
it seems so long ago. You're right, like Mosaic, CF Industries. And you're right, going back to 2021, January and February were two incredible months, like two of my best months ever. And then March, you just started to fall off a cliff. And, I was overextended at that point. So I gave back half of my gains in January and February and probably March and April. So I then had to work my way back up from there. Do you short it all, or would you rather just be out of the market and sitting on cash?
It's funny. Even when I was a day trader, people say you must have shorted, right? Just good markets, bad markets. I rarely, it's just something kind of like in my mind. I never felt very comfortable. Like even like my first year trading pro was 08, was a financial crisis. So, I mean, talk about, welcome to the jungle. And it's like throughout that, I still had a good year, especially for like a young guy starting all of this. And I always played the long side. I mean, early 2008 was almost a little bit easier than, let's say, last year, because 2008, again, the cyclicals are what led. That's kind of, that experience is what helped me to kind of anticipate 2022, the way it was going to play out. But in 2008, they were much bigger upside moves. But so once the market kind of broke midway through 08, I just kind of waited for extreme oversold conditions to put on trades. And so that was kind of enough to still get these rallies in a downtrend, which, everyone says you can't do, and it's difficult if you don't really gear your tools in the right way, but it's doable. But nowadays, like, because I'm not so focused on the very short term, if I see a bad market, I just go to cash and I kind of focus on other things. I have like some research projects that are going on, and so I kind of put a little more attention to those. And so it's just kind of I probably have better ways to spend my time than trying to make a dollar on a stock in a big drop.
It is hard to be patient, though. I mean, you get up every day, you listen to the markets, you watch, you look at the charts, you want to make money, and it is hard sometimes just to sit on your hands and do nothing, but it is sometimes the right thing to do. And I agree. I mean, shorting is pretty tough, and it feels like the best traders, the people that put up those monster returns over the long term, don't do it on the short side. They're either long or they're in cash. Let's talk about this year. I mean, what do you think of this market? What do you think of macro? Is it worth being in this market, or is it worth sitting on the sidelines and, waiting for some better setups?
So I really think we're transitioning now away from energy cyclical. I mean, you can see just oil, the way it's kind of fallen apart. Now it became
crazy. It's under $70 right now. Yeah.
Big drops. But do I think oil goes back to $30? I think there's been, systemic, shortfalls in investment in the sector. So that probably keeps like a longer term bid under the market. But do we kind of rally up to those $120 levels again? Not in the short term. I think coming out of this, the focus is really that the Fed will win this battle on inflation. If you're looking at forward indicators, you can see that those pressures are alleviating. Now looking at the banking crisis that we're dealing with, it almost seems like it's more deflationary problems to worry about. But this is really the Fed's in a really tough position. Part of it is self-induced.
I was just going to say, they created most of this mess themselves.
Yeah, exactly. And so it's kind of, but like I don't envy their position. I'll say it that way. But my focus, and you can just see it's really screaming right now, is growth now. And that's the way the market is now, that it's hated and everyone says, oh, look at all that junk from 2020, 2021, how beat up it is, blah, blah, blah. But now that's probably what's going to lead coming out of this, because the biggest driver of these rotations between growth and value are interest rates. So when rates are climbing aggressively, it makes growth less attractive, because, most of these growth companies, most of their earnings are far into the future. That's why they're growth companies. And so the higher rates go, the harder it is for these companies to finance, the bigger the opportunity cost to wait for these earnings. So that's kind of like a downward pressure on growth versus value. But especially, which I think we're near the top of this interest rate cycle in general, whether you look at the short term or the longer term. And so as that is kind of the tailwind probably going forward out of this, that's going to kind of push it back towards growth. So that makes me really bullish on growth. I actually had a really good start in January, which unfortunately gave back those gains as kind of February rolled over. I was almost kind of a little surprised at how fast the rollback went. I think it was really that kind of upside surprise in inflation, and people got worried and the trade broke down. But you can just see that if the market does strengthen, it's growth that's going to lead. Actually, even especially right now with this banking problem, what's holding up best? It's all growth. It's tech. And I think that's just Yeah.
You had the Dow Jones down 300 points yesterday at the close. You had the NASDAQ in the green, and today when everything started bouncing, it was the tech stocks that were bouncing first. So yeah, you're right.
And part of that is people love, big tech, mega cap tech, Microsoft and stuff, the liquidity. There's obviously never a cash concern for these guys. But even if you look at the smaller growth stocks, guys like Shopify, let's bring them back in. I mean, they should have been ruined by that kind of a market drop, and they held pretty strong. So that's why relative strength is so important, because it's not just the price change of the stock, but how it's doing versus the market. And it gives you such great insights about the rotations, which at times, like you mentioned in 2020, the rotations are so powerful. I mean, like, who cares even what the market's doing? It's the rotations that are huge. So you have to really keep an eye on that.
Do you have any positions right now? Are you long anything in your portfolio?
Yeah. So thankfully, like in a way, I mean, I wasn't thankful at the time, but midway through February, like a lot of positions started to fail. And I did have Shop from a great price in like the mid 30s, which kind of went up to the 50s, which was a big position of mine. I thought I was recreating my 2020 run. And then they had bad earnings. So that kind of like got me out at a smaller profit. And since then, I tried a few, nothing was really sticking. And that's really just the market kind of telling you there's something wrong. So when all of this kind of, worry about the banking panic, and if you look at small caps down 10, 12% in like a week's time, I was already in cash, kind of just waiting to watch. I didn't know what was going to hit, but you could just tell there's a deterioration internally in the market. So I'm in cash. I'm not a big bear. Banking panics are the biggest thing to worry about, because if that spreads, that affects everybody. Like, if let's say GM has a problem, like, yeah, that affects obviously the local area, and it's a loss to that type of capacity for the country, but that doesn't affect me and you. Banking affects everybody. So the problem needs to be solved. So the bullish case I take from this is, if the panic stops or the Fed does something to stop it, then the crisis is fixed and the Fed goes from being our enemy to our friend again. That's the basis for bull markets. The concern is if it's all these small like stopgap measures, like, oh, we'll just do this for this bank and do this for this bank. And you can see first it was SIVB, now it's FRC, then Credit Suisse is a problem. And I mean, who remembers 2011 with all the European debt crisis and all the different banks that had issues? So you can just look around the corner and say, hey, if Credit Suisse needed $54 billion from the Swiss National Bank, like, what do the Italian banks need? What do the Spanish banks need? What do the Greek banks need? And so until I get like a more definitive kind of response from the central banks, I'm cautious. But I think, just like in 2020, that could flip on a dime. If they come out and say, hey, look, we're using a bazooka, we're stopping QT, we're bringing back QE, and we see market surge, then it's game on. So it's almost like it's a bad situation, but could almost lead to a very good outcome if it ends up forcing the hand of the Fed.
I also think, there is like you said, the banking affects all of us. And, we watch this stuff all day long. We watch CNBC, we watch Bloomberg, we get news alerts. So, when things are failing, we know when and why. The average Joe Blow on the street doesn't follow this stuff as closely. And all of a sudden he hears from his buddy that Silicon Valley Bank failed and all these other bank stocks are down 50, 60%, they start to get really scared. And then you have middle America, not out there spending money. And then then inflation starts to plummet. So, I think this could be super deflationary, over the next 3 to 6 months, which means the Fed might have already gone too far. So, but they feel determined to keep going farther if they can. What would it take for you to get back into this market? What sort of a setup do you want to see? Is it just breadth? Is it certain stocks showing high RSI? Do you like when stocks gap up after earnings and then pull back to a 21, 23 or 50? Like what's your perfect setup?
For me, the basis, if you look at any bull market, you have more stocks making 52-week highs and 52-week lows. And that's where the easier environment comes. And you have to, like, in my opinion, as an active investor, like you mentioned, we're watching every day, my fear is never really a big bad bear market. I've never, in my entire career, actually, since I started trading, because I've always kind of respected my risk, I've never been caught on a big move against me. Just never happened, thankfully. To me, my big worry is chop. You get into an environment where you're active and you're trying to control your risk, and you get stopped and you put on a position, you add and you get stopped, and it gaps down because of news, and that can really wreck a portfolio. So for me, it's kind of a little bit of I'm never really concerned about the big drop. It's more, I want to see conditions improve where I have a little more confidence that the chop is over. I always, I have members or friends.
You just described my entire February.
Yeah, exactly. And it's brutal. And it's hard on the account. It's hard on the psychology because it's like, you're wrong, over and over. It's not a fun place to be. I've been there. And I always tell people, if you want to know how bad it can get, bring up a chart of the NASDAQ 2011 when there was a European debt crisis. And again, similar kind of situation. So you have to almost respect that it could be a similar situation in terms of chop. And it was for a good 3 months, every day, whole market gapping up 3%, gapping down 4%, gapping up 2%. If you're putting on short-term positions, you're wrecked. So for me, it's just it's a little more like either give me clarity that the Fed is our friend, or give me clarity that breadth shows, more stocks making highs than lows. So at least the market's telling me things have eased. Until then, it's just not that I won't put on any trades, but I'm not going to expose a big part of my portfolio, because if you're wrong on a small position, not so bad. If you start taking big positions, big exposure, and you get this back and forth action, you can get a 20% drawdown like in a couple of weeks' time.
So I know you're looking at technicals, price, volume, all that stuff. How much do you also pay attention to fundamentals, earnings revisions, insider buying, although you don't really see insider buying that much right now? Like what other indicators or metrics do you like to look at, to give you conviction that, these are the right 5 or 6 stocks that I want to be in right now, besides just the technicals?
Yeah. So for me, it's really twofold. It's the technicals, the relative strength and the price, but really it's the fundamentals. Like I've never really seen any kind of monster move on a stock if it wasn't showing really strong growth fundamentals. Like William O'Neill in his book put out the key tools. He always put a big emphasis on earnings. If a stock doesn't have earnings, but they have amazing sales, sometimes the market will reward the stock because, hey, we know you'll monetize it down the road. So that's why you have to kind of look at both ways. But I look for strong growth in sales and earnings, but you also want to see kind of record earnings and sales. So sometimes people will make the mistake of a stock that has a big drop and like they're starting to turn around, but there's a lot of damage to the whole story of the stock. So people want to know that the company's well run. People want to know that they don't have any baggage or debt problems. So when you're making record sales, record earnings, none of that is a problem. You're doing the best you've ever done. So it's like, you want to put Michael Jordan in your team when you see he's just winning championship after championship. If once and it never happened, but if he gets a bad injury, you don't want to say like, it's not really the same kind of Jordan, perhaps, if that would be the case, So for me, it's really those growth metrics are so critical. And if you look at every major winner, they're just killing it in terms of fundamentals. When did you ever see a stock with no sales, no earnings, or losing earnings, losing sales go on anything more than a 1 or 2 month like rally, which is a relief rally? So if you're looking for sustained moves, look for record numbers.
Right. Which is why right now, my top positions are Uber, Lantheus, Shift4 Payments, Mercado Libre, because they're all reporting great numbers, better than expected earnings, better than expected revenues. Analysts are raising price targets, blah, blah, blah. Like those are the stocks that I feel most comfortable owning right now, not the ones that are still losing money, like Coinbase and DraftKings and Roblox. Like those stocks still scare the hell out of me. They might move higher as yields come down, because the DCF models all get tweaked and now the, present value looks a little bit higher, but like that's still sort of a dangerous game to play with these companies that are losing money, might need to raise more capital, do a stock offering. Like those are the gap downs I want to try to avoid as well. What other sort of risk management rules do you have? Like when do you cut a stock? Do you have, is it like 5% stop loss no matter what? Or do you not use stop losses and you just watch it? And if it closes a couple times before you're, below your support level, you get rid of it? Like, what are your rules?
So I have like a bunch of rules that kind of just guide me. Like I try not to be too black and white because, I find it takes the fun out of things and, things are never really always exactly the same. But my risk management is very black and white. So the way I position is I always aim to have a stock be a 30% part of my portfolio, but I break it up into 3 buys. So that way I'm not putting on all the risk at once, because it'll happen that you're going to buy a stock and that night there'll be bad news. It's just going to happen. It's waiting for you somewhere. Yeah. So I always buy at 10% at a time of my portfolio. And I always want at least a 5% gain before I add more to the stock. So just naturally, by the time I get to a 30% position, I'm already making good money on the stock. But however I put on my position, I kind of set like a percentage of my portfolio that I'll lose maximum on a stock, which is about 0.75%. So whether I have a 10% position or a 30% position, if I'm down 0.75% versus my portfolio on that stock, it's gone and I start over. So that kind of allows me to concentrate, but keep my risk consistent regardless. And I feel like you have to keep that risk consistent, because if you want, the core of any investing strategy, whether your value, growth, whatever, reversion to the mean, trend following, the core is you need to make more when you're right than when you're wrong. But you can't control what you're going to make when you're right. All you can control is what you're going to lose when you're wrong most of the time, unless there's a gap. So I always have this very specific focus on what my maximum loss could be on the stock. And if it hits it, it's out and on to the next one.
When do you raise up stop losses? Like, let's say you got into Shopify at 30, it rallies to 40. Do you raise up your stops?
Yeah, so that's a question I get a lot. I do that a little bit different because these stocks can be so kind of jumpy and volatile sometimes. I found that just raising stops quickly can just lead you to always be stopped out of these really powerful moves early on. So I kind of run like almost like a time stop that then becomes a price stop. So whenever I get into a stock, unless there's an initial drop where it hits my exit, if it's moving up, I want to give it at least a couple of weeks, because I found when you're putting on a position, especially if you're kind of buying on the way up, the stock is almost short-term, a little bit extended. I mean, maybe you get another day or two, but there's going to be that back and forth action. So I've just found through intuition that, after a couple of weeks, you can tell if the stock really has legs. That gives it enough time to kind of pause after initial move, and then after really blast off if it's strong. So I always give it about that 2 or 3 weeks. If after a couple of weeks, there's not a whole lot of, excitement for it, then I look at all of my technical criteria, like how much am I up versus my risk? Should I just take the profit? Can I use an important trend line as my exit? Can I use a trend line? And that's why I bring in those tools. But if it's a real super stock and the first 2 or 3 weeks, like, wow, this is a real banger and this thing's moving, well, that stock I'm going to give leeway, and I'm going to go to a longer time frame, like a weekly chart, 10-week moving average, and give this stock time to play out.
Are there any stocks right now? I know you're all cash, but any stocks that you're really watching extra hard? And, if the Fed does something to shore up the banking system, if the Fed does or says something next week at their FOMC meeting to, make us think that it's maybe risk on, they're done with the rate, done with the rate hikes. Next could be rate cuts. I mean, who knows? Are there any stocks that are at the top of your watch list right now that you'd want to get into, assuming that, technicals look good? But I mean, I guess you've probably been studying some stocks based on fundamentals, most likely.
Yeah. So, I mean, that's the good part about this market is, even though the general market seems to be under pressure, there's a lot of good strength, and there's in individual stocks and some really great growth numbers. So you mentioned Mercado Libre, which, man, take a look at their forward earnings estimates. It's like monstrous growth for a stock of that market cap.
It's like 40 or 50% a year for the next few years.
Oh, incredible. I mean, and they have their e-commerce. They also have their all their payment processing platform. I mean, they're just monsters in their business, in their geography. So definitely Mercado Libre is one. AXON, I think, is doing phenomenal. They have this great new taser guns, all this new different offerings that they have. They have this really good, I think, I forget what it was, that they want to reduce gun deaths between police and people by 50% by arming them with better tasers. They need better tasers so the police officer's safe, but at the same time, if they don't need lethal force, right, it's a win-win for everybody. So AXON has great numbers, great growth, great price action. There's just a ton of stocks you could look at. Ferrari race is just doing phenomenal.
I haven't looked at that one in a long time.
Yeah, it's funny. All these sports car companies, which, I mean, I love cars. A lot of people love cars, and everyone loves a purebred sports car. But they're reluctant to put out an SUV. But every time like Porsche or Lamborghini puts out an SUV, it ends up being the bestseller. So Ferrari finally folded, and they put out like an SUV, which that could be a very good driver for sales. They've been doing very well. So there's really
most of those exotic car companies can't even make cars fast enough. Like every car they make is already sold 6 months, 12 months in advance.
It's incredible. I mean, and who would have thought? I wish I would have known. If you'd have told me when I was a young guy, hey man, go buy a Ferrari and you'll make a lot of money. I mean, if I would have known, that's all it took.
Some of those cars hold their value pretty well, and the older ones, end up increasing their value over time because they become, collectibles to a certain extent.
I agree. I mean, that is for the Ferrari LaFerrari, which they put out about 10 years ago. I think it was like a little over $1 million at the time. I just saw at the auto show, they were asking like $6 or $7 million for this thing. It's just crazy. I mean, whether you get 7 or you get 5, it's still a nice 500% return with a Ferrari. So it's not too bad.
When I was a kid and I was making $5 an hour at the convenience store, stocking shelves, I was using my paychecks to go buy baseball cards. But instead of buying using my entire week's earnings to go buy the really expensive rare baseball card, because then I'd only have one, I'd spend, all that money and just buy hundreds of, less valuable cards. And now, that rare card is worth 10 times, 20 times, 30 times more than it was 30 years ago. The other baseball cards are worth nothing.
Sometimes life lessons from funny places, Jonah?
What other pearls of wisdom can you share with us regarding, this is a tough market because, like you said, it just feels so choppy. I don't know if the next 10% is higher, if the next 10% is lower. How long are you willing to sit on cash for months and months at a time if necessary?
So I usually don't like I said, I try and hold longer term, but when you day trade for like 8 or 9 years, there's part of you that's used to constant action. So it's that, I think one of the hard parts for me is to sit on my hands when I do. So I'm usually out completely if I see a very high risk environment, but most of the time, at least I have some positions. But I think what I've learned over time, and even when I was a day trader, and I kind of like always analyze my trades and how I've done in my different periods of performance, my best money that I made was when I was dead on a trend, even though I was day trading, because I would always kind of have like a core position, trade around it. And so, for example, the periods like, 2009, 2010, I was like in the precious metals and gold was on a real banger move. And the stocks went like wild. When you had these core positions running and you were trading around them, that was always the biggest move. 2016, similar type of thing happened. So I've just come to realize like the big money, you can trade every day, but the big money is when you're really right early on a sizable trend.
So what could the next sizable trend be, coming out of this choppiness? I mean, is energy going to be back on? Do you think growth and technology will be back on?
So I think it's going to be growth. And that's another thing that took me a long time to realize is that the market rotations are driven by interest rates. So, interest rates affect the general market, but they even more so affect internal rotations and like value versus growth, or, high price of sales versus low price of sales. And it's all interest rates that really drive that. So I think just putting a lot of attention of waiting and understanding what the next big move is going to be and positioning early, because, another problem I had is sometimes, you get a sense of what a big move is going to be. You get distracted with short-term trades. By the time you come around, it's already a couple of months in progress, but you miss the best part, because getting in early, you have this same low risk, but you have many, many multiples of your risk as return. If you're just 2 months in, there's still money to make, but instead of making 400%, you make 60%, which is a huge difference if you're running this on multiple stocks. So like getting the big move right. If I look back at all the trades I've done, I used to trade it like 150 times a day. The biggest money I made, or the majority, is always just being really right for 3 or 4 months at a time. If you get a good 4-month cycle dead on, and it's a good proper bull move, you'll make more in 4 months than you'll make 3 years like day trading. So, and you can scale that. So for me, that's been my real focus. Understand the real big drivers, the big pushes, and then all the short-term stuff, that's all timing. That's all finding the best risk reward. That's just a way to kind of maximize the opportunity, but really identifying that big opportunity is the key for me now.
Awesome. Where can we find you? I know on Twitter, your handle is trader_M Caruso. You also run a investment service, correct?
Mm-hmm.
Is it Caruso Insights?
That's right. CarusoInsights.com. Yeah.
What sort of services do you provide there?
So what I do is it's like twice a week we have video calls. I have daily updates. what I try and do a little bit different is in each of the video calls, I kind of break it up into like a macro segment. Then I'll talk about the stocks I'm running in a portfolio. I kind of keep a hypothetical portfolio so people can understand exposure levels, which again, I think is so important. I give kind of how I think the market trend is doing. So I kind of run all that through an organized process. So it helps people kind of follow me along in real time as I'm actually trading. And so that's been really fun. And after also, I always have an educational segment where all this stuff, I'll talk about interest rates and short-term technical patterns and try and bridge the gap between macro trading and education. And so that's what I run. It's been a real pleasure, actually. I never saw myself as running one. Since I kind of started off a year ago, I'd created a course, breaking down my process. People love the course. Said, "Oh, can we do this in real time?" I said, "Okay, let's do this in real time." But it's been a great process, and really enjoy it.
Do you feel any pressure? I mean, because I deal with this too. I put out a weekly deep dive on a growth stock, and even when the markets are sucking or going down, like I still have a commitment to put out these write-ups, and it's sort of tough. Like I feel like I'm, stuck between a rock and a hard place. Like, last year was kind of hard to be bullish on growth stocks, but here I am pumping out write-ups every single week. Do you feel any pressure from your subscribers? Like, even though you're not bullish, you're not bearish, you're sitting in cash waiting, you have people like, are they expecting you to be trading because they need that action too? Or do they just respect you and your style and they know your background and your credibility and they're willing to just be patient with you?
It's a really good question, Jonah. And I think anyone who people don't underestimate kind of that pressure that people who offer something, like, people say, "Hey, I'm paying, I want to get something." But right. I think being able to be honest and say that, "Hey, look, right now the risks are just too high." And I always provide education behind my reasoning, which I think helps people. But, I have to say I've been really fortunate with members because I've only gotten emails, people saying, "Wow, Matt, I subscribe to a few services and, bravo to you to respecting that the market's not good and not putting stuff out." Like, we feel sometimes people just put stuff out because they have to, but we'd rather hear you, tell it to us straight. And that's what we appreciate. And we're really happy to be in cash in this bad market. So, last year, at least I was able to find some good trends, energy, fertilizers, so that there was at least some action to take. But, so far members have been I think what's important is that people who subscribe to you understand why you're doing things. I think, and even when I started off, I subscribed to stuff too, like way back when I was a kid, and sometimes just like buy and sell signals. But it's, how do you stay with someone if it's just buy and sell signals if you don't know why they're doing it and they run into a rough patch? So I think if you kind of explain the process, what you're doing, why you're doing, and that's why I started like the hypothetical portfolio, so people can get a sense of positioning levels. It's been a great experience, and members have really been happy to be in cash and to understand why.
Awesome. Well, thank you so much for being a guest. Really appreciate it. Hopefully one of these days we'll get a chance to meet in person. I know we wanted to last year at the FinTwit conference, but you weren't allowed to leave the country, so that made it a little bit tricky.
Yeah. Hopefully next time it'll be a little bit easier to travel.
Well, thank you so much, man. I really appreciate it, and certainly wish you the best. And I hope you're right about the next trend being growth stocks. That would make me very happy.
My pleasure. And that's the funny thing about the market. When everything's look really bad, it's good. When everything's look great, it's bad. So if things are not looking great right now, you could actually start to feel like good stuff is coming.
Agreed. Well, thank you so much, Matt. I'll talk to you soon.
You got it. My pleasure.
Bye.
Thanks.